Hey everyone, welcome back to Corporate Decoder, the place where we unpack company secrets, and today Douglas Elliman Inc. is spilling the tea on a big sale and some lingering financial tunes. Get ready for a deep dive into why a real estate giant is shifting gears and what it means for their bottom line. Before we jump in, if this is your first time here and you love getting the real story behind the corporate jargon, make sure you hit that subscribe button and the notification bell. We also have a fantastic community growing on Discord, link in the description below, where we discuss these filings in real time. So what exactly happened on the 24th of October 2025? Well, Douglas Elliman Inc., the well-known real estate company, announced a pretty significant disposition of assets. Essentially, they entered into an agreement to sell all of the equity interests in a subsidiary called Douglas Elliman Property Management, known to most as DEPM, to a company called The Purchaser. This sale technically closed on the same day the agreement was signed. This whole deal was brokered through an entity named Douglas Elliman Realty LLC, or DAR for short, which is an indirect subsidiary of the company. They agreed to sell their stake in DEPM to a Texas corporation acting as the purchaser. Now, this isn't just a small side. Hustle Sale, this subsidiary DEPM, was involved in managing cooperative condominium and rental apartment buildings in some key markets like New York City, Nassau County, Long Island City, and Westchester County. The financial implications of this DEPM sale are quite interesting. Douglas Elliman Inc. is expecting to recognize more than a $75 million after-tax gain in the fourth quarter of 2025. That is a substantial chunk of change, folks. They are selling off this property management arm for a base price of $85 million with some standard adjustments for things like cash debt and how much working capital was involved at the time of the sale. Digging into the agreement itself, it reads like most major business deals. There are the usual promises and assurances from both sides, for instance Douglas Elliman's sider, and DEPM assured the purchaser that they had the legal right to sell this business had been properly set up and were authorized to make this deal. The purchaser also made its own assurances stating they were properly organized, authorized to complete the purchase, and intended to hold onto this investment. Interestingly, the agreement mentions a representations and warranties insurance policy. This is a type of insurance bought by the seller or buyer to cover potential losses if those initial promises end up being wrong. It seems to be the main way the purchaser can get compensation for any untrue statements except in cases of fraud or specific agreed upon situations. Now here is where things get a bit more strategic. The contract includes a 5-year non-competition clause. This means that the seller DAR has agreed not to own, manage, or operate any business that does property management for cooperative condominium and rental apartment buildings in New York and Texas and any place else. The purchaser and its related companies operate. They also agreed to a 5-year non-solicitation clause, meaning they cannot intentionally try to get customers away from the new owners or poach certain employees from DEPM or the purchaser. There are also some clauses about employee transitions and ensuring that past managers and officers of DEPM are still protected with insurance and indemnification. Another key element is the trademark license agreement. Douglas Elliman Inc. will continue to own the rights to its name and logos. DEPM, however, will get to use certain trade names and logos for a specific set of property management services for 5 years starting from the closing date. This suggests a plan for the DEPM business to operate under the Douglas Elliman banner for a period even after the sale. They also agreed to maintain a referral arrangement to keep that business relationship going. Now let's look at the financial picture more closely. The filing includes unaudited pro forma, condensed consolidated financial statements. These are basically adjusted financial statements showing how things would look as if the sale had already happened on past dates to give us a clearer picture of the impact. The unaudited pro forma condensed consolidated balance sheet as of the 30th of June 2025 and the statements of operations for the 6 months ended the 30th of June 2025 and the year ended the 31st of December 2024 give us a glimpse of this. There was also a change in leadership tied to this event. Effective immediately after the closing, David K. Chain, who is a director appointed by Climmer, holder of convertible notes, resigned from the board of directors and any committees he was on. The company stated this was not due to any disagreements, and here is another major financial move. In connection with and upon the closing of the DEPM sale, the company also agreed to repay and redeem all of its senior secured convertible promissory notes. These notes were originally due in July 2029, and the repayment amounted to $95 million plus some accrued interest, pushing the total repayment higher. This happened because the note holders were not willing to waive their rights and instead agreed to a redemption linked with the asset sale. After this sale and the repayment, Douglas Elliman Inc. had approximately $130 million in unrestricted cash. This filing also references Exhibit 99.1, which contains the pro forma financial information. It is incorporated by reference and contains the balance sheet as of the 30th of June 2025 and the statements of operations for the 6 months that ended on that date and for the full year of 2024. This exhibit is key to understanding how this sale is shaping their financial future from a historical perspective. Overall, Douglas Elliman Inc. is making a strategic move by divesting its property management arm. This sale is bringing in a significant amount of cash and is expected to generate a large after-tax gain. The company is strengthening its balance sheet by repaying debt using the proceeds from the sale. It appears they are focusing their resources on their core brokerage business. A key risk here is how well they can sustain growth without the recurring revenue from property management and whether the non-compete and non-solicitation clauses will truly prevent former employees or themselves from re-entering that market in the future if market conditions change. The reliance on maintaining a referral arrangement with the buyer highlights an ongoing need for collaboration even after the sale. So what is our take? Douglas Elliman seems to be streamlining its operations and improving its financial flexibility. This could be a smart move to navigate a potentially challenging real estate market by shedding a segment that might have different operational demands. The large gain and debt repayment are definite positives. We will be watching to see how this impacts their revenue streams and profitability in quarters to come, and if they can leverage that cash for strategic growth in their main brokerage services. Alright, that is our breakdown of Douglas Elliman Inc.'s latest filing. What is your take on these numbers and what they signal for the company's future? Let us know in the comments below. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate finance. Don't forget to check out the Discord, link in the description for more discussions. Thanks for watching, and we will see you next time.